Afternoon, everyone. On behalf of your Baird financial advisor, we welcome you to this month's Baird Wealth Strategies webinar. Our topic today is going to be focused on Social Security, and we're honored and have the pleasure of having Ms. Kara Endres join us today. As you all know, Social Security can be one of the most complex government programs to understand. So today we're going to cover eligibility of the benefits, how your benefits are calculated, benefit claiming strategies, as well as the current outlook on Social Security as a whole here. And as I mentioned earlier, to break down this topic, we're very excited to welcome Kara Endres today. Kara is a financial planner serving all of clients of our financial advisors in the state of Michigan, Kentucky, as well as Indiana. And prior to joining Baird's financial and estate planning team, Kara was a wealth planner with the planning team over at Hilliard Lyons. And as an extended member of your Baird financial advisors team, Kara focuses on comprehensive planning solutions offered up for our high net worth individuals and clients. She helps those individuals and families put together a roadmap as well as a strategy there to go ahead and achieve their goals and objectives there throughout their various life stages. So very eager and excited to have Kara join us. A little bit more about Kara. She definitely enjoys spending time with her family. I know they're a competitive bunch and very active and outdoorsy bunch there. Enjoys a ball game, if I'm not mistaken, Kara. But more so on her career and how she kind of landed in the planning realm. Kara got in, I believe, in 2009, and she's held her certified financial planner designation since 2011 there. Kara is also a graduate of Ball State University. So if we got any alumni on the call there, feel free to give her a nice welcome. But before I go ahead and turn the call over for Kara to start delving into Social Security and some of those strategies here, just wanted to go over a couple housekeeping items here for everyone to note. So again, for optimal viewing, we suggest that you go ahead and set your layout to the side-by-side view. You can do so via the circle in the little pill circle there that says layout in the top right corner of the screen. And then all participants are going to be in a listen-only mode here, but we'd love to hear from you, and we'd welcome you to leverage the Q&A function to chime in and share any questions that you may have for Kara here throughout the presentation. At the end of the session, we're going to go ahead and host that Q&A session, and we'll be sure to address as many questions as we can. And then one last note, our presentation is being recorded this afternoon, and it will be available along with the slide deck that Kara is going to take us all through. So connect with your financial advisor. Feel free to reach out to them and go ahead and ask for a copy of the presentation and link to the recording. I know we'd be happy to share those resources with you all. And with that said, Kara, welcome and thank you for joining us. I'll turn everything over to you from now.
Great. Thanks, Caleb, for the introduction. I'm excited to be here this afternoon to talk about Social Security with you. Social Security is a key component to a lot of retirees as they approach retirement. As Caleb referenced, Social Security can also be one of the most complex government programs to understand. So that's why I'm excited to be here today to talk about this topic. The timing of benefits, on its face seems like an easy decision to make, but there's a lot of factors to consider when, coming up with the decision of when to start drawing that Social Security benefit. So our goal today is really to help equip you with the knowledge and information necessary to help you make the decision, based on your personal circumstances. So we're gonna dive right in here. So today we're going to talk about how to determine your benefit amount. We're going to spend a little bit of time talking about a special provision in Social Security that impacts individuals that may have had jobs where they receive a pension and did not pay into Social Security. We're going to talk about some timing and things to consider when trying to decide when to start your benefits. We're going to dive into some spousal planning strategies. We're going to take a brief look at the outlook of Social Security and its solvency going forward. And then we're going to talk about some ways that you can work with your financial advisor when analyzing, your personal situation and the best time for you to claim Social Security benefits. So we're going to dive right into how do you determine what your benefit amount is going to be. So first, you have to have 40 quarters of earnings history to be eligible for Social Security benefits. In 2021, for every $1,470 that you make in that year, that counts as one quarter of credit towards your benefit. You receive a maximum of 4 quarters per year. The timing of that income is not important. It is really the dollar amount. So, for example, if you worked 2 months of the year, but you earned $3,000 in that 2-month period, you would be credited with 2 quarters of work history. So again, the timing of the income isn't important. It's really the dollar amount that you earn each year and counting towards those quarters. So when calculating Social Security, they look at your 35 highest earning years when they're calculating your Social Security benefit. Now, if you had years where you did not work at all and you did not earn an income, you would receive zeros for those years. There's a certain dollar amount maximum that's used when calculating your benefit. And in 2021, that maximum amount is $142,800. So any earnings over that limit would not have any impact on your Social Security benefit. There's also a maximum that an individual at full retirement age can claim and draw from Social Security. So in 2021, if someone reaches their full retirement age and they had 35 years where they hit that maximum of earnings every single year during those 35 years, their benefit would be $3,148 a month. One tip that I want to point out here is, your earnings history and the accuracy of that earnings history is what your benefit is calculated on. So one thing, just one walk away for today is if you have not checked your Social Security statement in recent years, we really encourage you to take a look at that Social Security statement and make sure that your earnings history is being reported accurately. Social Security statements are not mailed out anymore. You actually have to go to ssa.gov, register for an account, you create a username and password, and once you have access to that account, you'll be able to pull a recent copy of your Social Security statement. Another nice feature is once you have an account, you will receive an email on an annual basis that reminds you to check that Social Security statement. So you'll receive an email that says your Social Security statement has been updated. Please log in and take a look at that earnings history. So again, if you have not checked that statement in recent years, we definitely encourage you to check that earnings history for accuracy. So when is full retirement age? Your full retirement age, or the year that you could receive your full benefit, is based on the year in which you were born. So if you were born between the years of 1943 and 1954, your full retirement age is age 66. If you were born between the years of 1955 and 1959, your full retirement age is going to be 66 in some number of months. And then 1960 or later, full retirement age is age 67. Your benefit amount is also sometimes referenced as the primary insurance amount, or you may have heard it called the PIA for short. So there is an impact to your benefit if you take your benefit before your full retirement age. If you take your benefit up to 3 years prior to your full retirement age, you're going to experience a 6.7% decrease for every year that you claim early. And then if you claim more than 3 years early, that decrease is a 5% annual decrease, again, for every year that you claim early. So if we look at an individual that has a full retirement age of age 66, if they were to claim at age 62, they're going to experience a 25% reduction in their benefit for their claiming period. And then if your full retirement age is age 67 and you claimed at age 62, it's going to be a 30% reduction in that benefit for your lifetime. On the flip side, if you choose to delay your Social Security past full retirement age, you actually receive a pretty significant increase in your benefit. So every year that you wait past your full retirement age, you would receive an 8% increase in your benefit. So again, someone who reaches full retirement age at age 66, if they were to wait until age 70 to claim their benefit is going to grow, be 32% higher than it would have been at their full retirement age. And then at age 67, if your full retirement age is age 67 and you wait until age 70, you would experience a 24% increase in that benefit for your lifetime. So that's a pretty significant increase in annual income every year if you're able to hold off and claim Social Security at age 70 versus your full retirement age. There's also an impact to your benefit if you continue working during your retirement years. Once you reach your full retirement age, you can earn as much as you want and there's no impact to your Social Security benefit. However, if you decide to claim Social Security early and you continue working, your Social Security benefit could be reduced, again, due to an earnings limit. And we'll take a look at that here in just the next few slides. On the flip side, if you do continue working during your retirement years, your benefit could increase because you could be replacing some lower paid years with some higher paid years. Because again, the 35 highest years of earnings are used to calculate your benefit. So let's dive a little bit deeper into this idea of the earnings limit and claiming Social Security early, but still continuing to work. So there is a limit on how much you can earn on an annual basis before that the impact occurs. So in 2021, that earnings threshold is $18,960. It's important to note here that the only earnings that counts towards that limit is earned income. So income such as withdrawals from retirement plans, pensions, investment income, those types of income do not impact that earnings threshold. It's just your earned income. If you draw your Social Security early, so before your full retirement age, and you make more than $18,960 in earned income, $1 for every $2 above that threshold is going to be withheld. And it's actually calculated on a monthly basis. So the monthly earnings limit is $1,580. The year that you turn your full retirement age, that threshold increases pretty significantly. So it goes from $18,960 to $50,520 in 2021. And instead of $1 for every $2 above that threshold being withheld, it'd be $1 for every $3 above that threshold. So let's take a look at an example to see how that actually could impact a retiree who's deciding to claim early. So let's pretend that you're 64 and you're claiming your benefit early, and your benefit would be $12,000 a month if there were no impact to your benefit. However, you're still working and you're earning a salary of $36,960 a year. So you take your salary and you subtract out the threshold, which means that you have $18,000 of excess earnings above that threshold. Divide that by 2 to account for the $1 for every $2 above that threshold, and we're going to have $9,000 of lost benefits based on that earnings limit. Meaning, instead of collecting $12,000 that year, only $3,000 of benefits will be collected because of that earnings limit. Now, your payment is adjusted not on a monthly basis. So, 100% of the payment is going to be withheld until that cumulative loss benefit amount is paid. And then once they've withheld that amount, you will receive your full Social Security payment the months following that. So in our previous example, we had $9,000 of lost benefits. We had $3,000 of benefits that would actually be collected. So to account for those $9,000 of lost benefits, no Social Security check would be received for the first 9 months of the year. So they're going to hold that check from January through September. And then starting in October, the retiree would receive $1,000 a month for those last 3 months, October through December. Now, once you reach full retirement age, if you were subjected to the earnings limit, they do adjust your payment. So you don't lose those payments forever. However, they are not paid out in one lump sum. They're paid out over time. So it will take you time to collect those benefits that were lost during those earnings limit years. And that new recalculated amount isn't going to start as soon as you turn full retirement age. It's going to start the January after you turn full retirement age. So for example, if we take a look at our example here, let's say that 12 months of payments were withheld during that pre-full retirement age space, and you claimed your benefit 2 years early. So once you reach full retirement age, they will recalculate your benefit as though you retired only 1 year early versus the 2 years to account for the 12 months of payments that were withheld. But again, you're not going to receive that in one lump sum. They're going to pay it out over time. So it's going to take you time to be made whole on those missed payments during those early retirement years. Another potential area that can impact how much you actually draw from Social Security is the taxation of Social Security. So lower income taxpayers are not going to pay any federal taxes, federal income taxes on their Social Security benefit. However, as provisional income goes up, which we're going to talk about what provisional income is, as provisional income goes up, a higher percentage of your benefit becomes part of your taxable income. The most of your benefit that's going to be taxable is 85% of your Social Security. So no more than 85% of your Social Security is going to be part of your taxable income. So let's talk about what provisional income is. So the earnings limit only takes into account earned income. But when we're looking at taxation of Social Security, provisional income is looking at all income sources. So at that point, we are looking at income from investments, pension income, withdrawals from IRAs and 401ks. They also add back in any tax-exempt interest income into that provisional income number. And the last item is 50% of the Social Security benefit itself is part of provisional income. So if we go back to the table on the previous slide, for a married couple filing jointly, if your provisional income is over $44,000, 85% of your Social Security is going to be part of your taxable income. And then for a single filer, if your provisional income is over $34,000, 85% of your Social Security is going to be part of your taxable income. State taxes can also be, something to consider here. There's 13 states that still tax benefits in some form. 28 states plus the District of Columbia exempt Social Security from state income tax. And then we have 9 states that have no income tax at all. All right, now we're going to dive into an area here, the windfall elimination provision and government pension offset provision of the Social Security Code. So again, this impacts a unique set of retirees. And the 3 areas that we need to take a look at here are those that have less than 30 years of substantial earnings. So in 2021, substantial earnings is defined as $26,550. So as long as you had, $26,550 of earnings in 2021, that would count as a year of substantial earnings. The other area is that it's an individual that did not pay Social Security tax while working in a job that included a government pension. So this is often individuals that may be a federal government employee, a civil employee, and then teachers in some states also did not pay into Social Security system, but receive a pension from their work in those areas. And then this individual also, due to other work history, did qualify for Social Security benefits from other jobs where they did pay Social Security tax. One thing to be aware of is that if you take a look at your Social Security statement and you are a worker that may be impacted by WEP or GPO, those are not reflected in the amount that you see on your Social Security statement. So if the windfall elimination provision or government pension offset could impact you, your Social Security statement may show a higher amount than what you will actually receive. So just something to be aware of there. The windfall elimination provision comes into play when looking at your own benefits. So not spousal benefits or survivor benefits, strictly looking at your own benefit as a worker. And it impacts what is called the average indexed monthly earnings, which is the calculation that they use to average together those 35 highest paid years of benefits. For a standard worker that's not impacted by the windfall elimination provision, that average indexed monthly earnings amount is tiered. And that first tier is $926, and that amount is multiplied by 90% for a standard Social Security claimant. The next 5,583 is multiplied by 32%, and then the remaining earnings are multiplied by 15%. For an individual that's impacted by WEP, it's that first tier, that first $926 that's impacted. So if we take a look at our chart here, and let's say that we have a retiree that had 25 years of substantial earnings. So instead of that first tier being multiplied by 90%, that first tier is going to be multiplied by 65%. The other two tiers remain the same for everyone. The windfall elimination provision, or WEP, is never going to eliminate your Social Security altogether. So in 2021, the maximum WEP reduction is going to be $498. Or if you take a look at the chart, for 20 or fewer years of substantial earnings, it's 40% of that $926, that first tier. The WEP reduction is also limited to 1/2 of your pension. So it's never going to reduce your Social Security by more than 1/2 of what your pension amount is. The government pension offset is a reduction that applies to spousal and survivor benefits. And that reduction is equal to 2/3 of what your monthly pension amount is. In this case, this pension offset could potentially eliminate Social Security benefits altogether when it comes to the spousal and the survivor benefit. So if you have an individual that has a $1,000 monthly pension, again, from a job where they, or career where they did not pay into Social Security program, the Social Security reduction would be $667 for those spousal and survivor benefits. Now we're going to talk a little bit about deciding when to start taking your benefits and some things to consider as you make that claiming decision. So one of the first things to think about is the fact that you do get an 8% increase in your benefit for every year that you wait past your full retirement age. If you are in a situation where you have other income sources or investable assets to help fill that gap between full retirement age and age 70, maybe you would want to consider holding off as close to age 70 as possible and experience that 8% increase in income every year. If you are someone who has, legacy goals to the next generation, then maybe you would want to entertain the idea of claiming Social Security earlier to help preserve your asset base to pass on to the next generation. Continuing to work is another thing to consider. Again, that earnings limit really comes into play. So if you're age 62 and you're going to continue working and earning above that earnings limit, then maybe we want to hold off on claiming Social Security until we get closer to full retirement age or you retire completely altogether. Health considerations are also something to consider. So if you want some extra cash flow, maybe in the early retirement years, when you're healthy and traveling and eating out and enjoying that extra cash flow, maybe we turn Social Security on earlier. On the flip side, if you want, a higher benefit during the later years of retirement, when potentially costs could be higher for medical reasons, maybe on the flip side, we hold off on Social Security to full retirement age or past. Medicare implications are also something to consider. So when you file for Social Security, if you are eligible for Medicare, you're automatically enrolled in Medicare Part A. And if you're making HSA contributions and you're still working, those contributions will no longer be able to be made. So once you are enrolled in Medicare, HSA contributions have to stop. So that's a key consideration as well. And one area that I often hear when talking to planning clients is the mentality that, you know, take it while you can get it, because the solvency of Social Security is something that definitely weighs on a lot of retirees' minds. And then life expectancy, you know, what does your, from a generational standpoint, do we have a long life expectancy that we need to plan for that income for? Or on the flip side, the potential for a shorter life expectancy. So we're going to dive into this idea of life expectancy here in the next couple of slides. So we have a retiree here's full retirement age at age 66. And if they were to wait until age 66, their benefit would be $2,000 a month. If they were to take their benefit early at age 62, they would experience that 25% reduction in benefits and receive $1,500 a month. On the flip side, if they waited until age 70 to claim their benefit and experienced that 32% increase in benefit, they would receive $2,640 a month. So if we take a look at the cumulative benefit over time, you're going to see what the break-even ages are, you know, comparing claiming early versus full retirement age, and then full retirement age compared to age 70. So if we take a look at the age 62 and full retirement age, you'll see around the age 75, so mid 70s to late 70s is when it starts, when the age, full retirement age amount starts to be more from a cumulative standpoint than claiming your benefit at age 62. And then if we compare full retirement age to waiting until age 70, that break even is around age 80, age 81. So around your early 80s, if you had waited until age 70 to claim your benefit, you would have claimed more from a cumulative standpoint by waiting until age 70 versus claiming at age 66. You know, as far as life expectancy goes, it's also important for a married couple to consider the life expectancy of both spouses. Because, you know, when you claim Social Security, you could potentially be impacting how much your spouse receives from a survivor standpoint. And we'll talk a little bit more about that when we get into some spousal claiming strategies. But again, it's important to consider both spouses' life expectancy when looking at these cumulative lifetime benefits. So that segues us perfectly into the next area of discussion, and that's the spousal planning strategies. So if you have one worker, there's actually multiple people that could potentially benefit from your earnings history as a worker. So the worker themselves can benefit, obviously, from their own work history. A spouse could potentially claim on a work history, a surviving spouse or minor children. An ex-spouse could benefit from a worker's work history, a surviving ex-spouse, and potentially parents if you are substantially supporting your parents' lifestyle as well. We're going to dig into a few of these a little bit deeper. So benefits for a spouse. If a married couple goes to the Social Security office or website to claim benefits, they're going to take a look at the benefit on your own record, and they're also going to look at the benefit based on your spouse's work history. And you're going to receive the larger of either your own benefit, 100% of your own benefit, or 50% of the benefit based on your spouse's work history, whichever is larger. Generally, you must be married for at least a year before you can collect spousal benefits. It's also important to note that the spouse has to be claiming and receiving benefits for the other spouse to file and claim a spousal benefit on his or her work record. So you would both have to be claiming and drawing benefits to open up the ability for that spousal benefit. For a surviving spouse, the same thing is going to occur. If you are a widow and you go to apply for Social Security benefits, they're going to look at both your work history as well as your deceased spouse's work history. And unlike the spousal benefit, they're going to give you the greater of either your work history or 100% of your deceased spouse's work history. The maximum benefit available is at full retirement age when it comes to surviving spousal benefits. And you can claim benefits as early as age 60. So unlike on your own record, you can claim on your own record as early as age 62. But from a surviving spouse standpoint, you could have access to those benefits at age 60, obviously at a reduced amount because you're claiming before your full retirement age. You must have been married for at least 9 months, except unless the death was due to some type of accident. And you must not have remarried before the age of 60. So if you are a widow and you get married after the age of 60, you could actually still be able to access the Social Security record of your deceased spouse. When it comes to surviving spouse claiming strategies, this is another one to really work with your advisor if you fall into this category, because you may have the option to switch between one record to the other. So you could claim on your own benefit or a surviving spouse benefit and then flip to the other record when it becomes greater. So again, there are some planning strategies here for surviving spouses to talk to your advisor about. A surviving ex-spouse also has access to the record of their ex-spouse if they were to predecease them, and they can begin benefits as well as early as age 60. And then if you remarry after age 60, the same rules apply. You could also have access to that ex-spouse's work history. You must have been married for at least 10 years and again did not remarry before the age of 60 to have access to your ex-spouse's record as a survivor. So benefits for ex-spouses. So multiple people, so if you have an individual that's been married multiple times, multiple ex-spouses can claim on one single worker. The claim on that single worker does not impact anybody else's benefit. So it's not going to impact the benefit to an ex-spouse. It's not going to affect your benefit, the current spouse, or any other exes. If you are a divorced spouse and you get remarried, then that benefit would no longer be available to you or stop, regardless of what age you got remarried. So as soon as you got remarried, those divorced spousal benefits would stop or no longer be available. Like the survivor benefit, you must have been married for at least 10 years to have access to your ex-spouse's record. You must have been divorced for at least 2 years unless the worker had already been receiving benefits at the time of the divorce. And then a person, receiving divorce spouses, again, once you're remarried, that income would stop. Just like your own record, an ex-spouse record becomes available to you at the age of 62, and it follows the same rules as a married spouse. You're either going to get your own benefit or up to 50% of your ex-spouse's benefit if that benefit is higher. There's one unique provision for a married couple or an ex-spouse, actually, and it's called a restricted application. And what that does is it says, I'm claiming benefits, I'm filing for benefits, but I'm going to restrict my application to just my spousal benefits, and I'm going to allow my own benefit to continue to grow and switch to that record later. Now, there's a limited amount of people or number of people that this option is still available to you. You must have been born before January 1st of 1954 or earlier, and you can only do a restricted application if you are full retirement age. And again, the same rules apply for a divorced spouse as well. Now we're going to spend a little bit of time looking at the outlook for Social Security and its solvency over the long haul here. So whenever you're looking at reports or people are talking about the solvency of Social Security, there's actually two separate pools of money that are used to fund two very different pools of needs. And one of those is the OASI, it's the Old Age and Survivor Income pool of money. And that's the pool of money that's paying Social Security for retirees, survivors, and their families. And then there's the DI, which is the disability income benefits paid to disabled workers. These are two separate pools of money that currently legally cannot be combined. So one cannot fund the other. However, when you're looking at projections on the solvency of Social Security, the Board of Trustees often assumes that both of these funds at some point could be commingled and allowing one fund to cover the obligations of the other. So that pooled trust fund of money is called the OASDI when you put both of those pools of money together. When you're looking at projections, you're also going to hear, what are the short range projections? So that's looking at a 10-year period. And then the longer range projections are looking at a 75-year period of time. They also use different factors when they're looking at assumptions. The one that we're going to be looking at today is the intermediate outlook on Social Security. So it's going to be, again, kind of right there in the middle. The low cost assumption is going to have a more positive outlook on Social Security going forward. And then the high cost would be the flip side. That's going to have a less positive outlook for Social Security going forward. So today, when we're talking about these projections, we're going to be looking at the intermediate assumptions. And right now, the long range forecast shows that if you combine both of those pools together as the OASDI, the current trust fund is going to cover costs until 2035. Now, it doesn't mean that in 2035, all benefits are cut off. What it means is that going forward, payroll taxes at that time are only projected to cover 79% of promised benefits going forward. Now, there are some things that can take place to help ensure the solvency of Social Security for the next 75 plus years. And some of those include decreasing benefits going forward, and some of those include increasing taxes going forward. So right now, if you have a job where you're paying into Social Security, you are paying a 12.4% payroll tax. Half of it's paid by you and half of it's paid by your employer. If they were to increase that 12.4% payroll tax to 15.54%, that would project funding for Social Security at their current levels for the next 75 years. Another option would be to reduce all benefits by 19% today, or if they were just to target those that are about to claim, they would have to reduce benefits by 23% for new claimants to Social Security. So that would, again, increase solvency of the current fund for the next 75 years. If we were to wait until 2035 to take any sort of action, instead of a 15.54% tax, that 12.4% tax would need to be increased to 16.53%, or all benefits would need to be reduced by 25% to ensure solvency for the next 75 years. There are some additional proposals out there. One of those is to limit the cost of living adjustments or to reduce cost of living adjustments by 1%, beginning with payments going forward. And that would extend the fund, the combined fund, for another 10 years to 2045. Another option that's often talked about is gradually increasing the full retirement age from age 67 to 68, just like they did some years ago to increase full retirement age from 66 to 67. But that's not going to have a huge impact. That's just going to extend that combined fund by 1 year. Another potential option is to remove the earnings cap. So we talked about that $142,800 cap before. So the most of your income that you earn on an annual basis that would be taxed for Social Security purposes $142,800 in 2021. If they were to remove that cap and subject all of your earnings to that 12.4% payroll tax, and also provide credit for your benefit for however much you earn, even if it's above that $142,800, that would extend the OASDI to 2056. The other option would be to remove the earnings cap, subject all your earnings to 12.4%, but still keep the benefit calculation limit maximum on that $142,800 of earned income. And that would extend at least 30 years to 2065. So in conclusion, when we're looking at the outlook on Social Security is facing bankruptcy in the next few decades. However, again, this doesn't mean that benefits are going to stop. What it means is that ongoing payroll taxes, as they continue to fund future benefits, would need to be cut by 25% in 2035. So would only be able to continue 75% of projected benefits. The key here is the longer a solution is delayed, the more severe the changes must be. And I think it's probably safe to say that no one solution is going to be palatable for everyone. Most likely, if when changes occur, it's going to be a combination of both changes to revenue, so increases in taxes, maybe those payroll taxes, as well as an adjustment to potentially benefits over time, whether that be changing full retirement age or some type of reduction in benefits over time. So I think it's going to be a combination of both. And I'm going to end today talking about some ways that you can work with your financial advisor to help analyze your options when looking at your individual circumstances. And one of those is a standalone Social Security analysis. So in this analysis, your advisor will be taking a look at your Social Security statement, and if you're married, the Social Security statement of your spouse, and taking a look at different claiming strategies and how much your cumulative benefit would be if you were to say both claim early or both wait until age 70, or potentially do a combination where one spouse claims early, one spouse holds off until age 70, and help provide some numbers and some framework around that conversation in terms of cumulative benefit over time given a certain life expectancy. The other way your advisor can help you analyze your benefit and the impact to your personal situation is through a comprehensive financial plan. In a comprehensive financial plan, we're not just looking at Social Security on its own, we're taking a look at other income streams, investable assets, and how all of those work together to help meet your retirement goals. And what is the impact to your probability of success given different Social Security claiming strategies, and again, encompassing that whole financial picture. So I encourage you, if you are getting close to Social Security full retirement age or age 62, or making a decision on Social Security, I encourage you to reach out to your financial advisor and allow them to help frame this conversation with you, again, looking at your specific situation, your family's specific needs. A couple of resources just to wrap us up here. I encourage you to visit ssa.gov. Again, there's lots of calculators and great information on their website, but also, again, just putting it out there to pull that statement, create an account, verify those benefits, and make sure everything is being reported correctly. You can also apply for Social Security benefits and Medicare directly from the ssa.gov website. And then there's also a wealth of information from a tax standpoint via irs.gov. So I'm going to pass it back over to Caleb to wrap us up here a little bit. And while he's doing that, I'm going to look at, see if we have any questions out there that need to be answered.
Well, thank you so much, Kara. Very informative. I know I personally, and I'm sure everyone else on the line, very much values your expertise here. So thank you for taking the time to educate us all this afternoon. While you're kind of taking a look through, I know we did have a couple questions come in, but just want to use this as an opportunity to remind everyone that if you do have any questions that you'd like to address to Kara here, and we'll try to make our way through getting through as many of them as we're able to, but please feel free to leverage the Q&A function. You should find that right in the bottom right-hand corner of your screen. And then when you're addressing it and sending in your question, just be sure to address your question to all of the panelists here. That way we'll make sure that we can route it. And if we're not able to get to your question today, we'll be sure to be in touch with your wealth management team or your financial advisor to follow up and connect you with the appropriate resources here. So Kara, with that, I'll give it back to you to address one of the questions that you're able to make out there within our Q&A.
Yeah, so one of the questions was to repeat the impact of Social Security on Medicare. So the key there is that once you claim Social Security, if you're age 62, you can no longer make contributions to a health savings account. So it doesn't really impact your Medicare per se. Now, if you are drawing Medicare at the time that you claim Social Security, that Medicare premium is going to come directly out of your Social Security benefit. So that Medicare Part D and premium, again, will come directly out of your Social Security payment before it's direct deposited into your bank account. See here. Do those taking Social Security prior to full retirement age receive the annual cost of living increase? Yes, anyone that's receiving Social Security is going to receive cost of living adjustments on an annual basis. Great question. There's a question in here about surviving spouses. Do I have to sign up with Social Security to have my spouse receive benefits after I die? No, no, there's no pre-signing up for Social Security. If you were to predecease your spouse and your widowed spouse went to go file for benefits, they are going to pull what his or her benefit is, and then what your benefit would have been, and then they will receive the higher of the two. So there's no need to do anything preemptively there. See here. Yes, so another question. So to determine whether WEP will affect me, do I look at my Social Security statement for my annual earnings, and do I count the years that they are above 26,000? So the substantial earnings changed over time. So there's actually, if you go to the Social Security website, there's a chart that lists what was considered substantial earnings all the way back to, I believe, the 1950s. So you would need to take a look at your earnings history year by year and see if you met the criteria for substantial earnings in each of those years, and then count how many years that you met that criteria. So that $26,000 amount is just for 2021, and it's different for every year. Again, based on cost of living over time. Lots of questions about the copy of the slide deck. Yes, that's going to go out to all participants, so you will have a copy of that slide deck. Another great question. Can I start using Medicare at 65 but delay receiving my Social Security to full retirement age or later? Yes, you can. So those are two independent variables there. So you can begin Medicare at age 65. You would just be making those premium payments yourself, through your bank account. And then once you signed up for Social Security at full retirement age or after, then they would begin deducting your Medicare premiums directly out of your Social Security check. But yes, you can claim Medicare, but delay Social Security past that age. Taking a look here. In the case of divorced spouses, does the higher earner have to be collecting Social Security for the ex-spouse to collect? That is an excellent question. Actually, no. So a married couple, the spouse has to be collecting for you to be able to get spousal benefits. And an ex-spouse, a divorce situation, the ex-spouse just has to be eligible to receive benefits, meaning they have to be 62 or older, but they do not have to be receiving benefits for you to file on an ex-spouse's record. But again, it would be either your own record or 50% of your ex-spouse's record if that was higher. But yes, very, very good question. That's a very distinct difference between current married spouses and divorced ex-spouses. A lot of repeat questions here, so I'm just going through. So if a spouse never worked and no income and they did not qualify for the 40 quarters, are they eligible for Social Security? So they're not eligible for Social Security on their own record, but they would be eligible for a spousal benefit, which would be up to 50% of your benefit. So yeah, they are eligible, just not on their own record since they don't have their own record. They would receive that 50%, up to 50% for that spousal benefit. Okay, so assume a surviving spouse reached full retirement age and collected her Social Security benefits and then passes. Can she switch to get the 100% Social Security benefit? Yes. So if you've already claimed and you're claiming on your own record and something happens to your spouse or ex-spouse and they pass away and 100% of their benefit is higher than yours, then yes, you could switch to either that surviving spouse or that ex-spouse's record and receive 100% of theirs. Mm-hmm. Let's see. If filing for Social Security at full retirement, how early do you need to sign up? Another great question. So we do recommend that you start that filing process 3 months prior to your full retirement age because it does take time, and then you'll receive the benefit the month that you turn your full retirement age. And same if you're claiming early. So you want to start that claiming process a couple months before you turn age 62 if you're deciding to turn that benefit on early. All right, I think I made my way through the questions here. Again, if there was a question that did not get specifically addressed, please reach out to your financial advisor. They would be happy to point you in the resources or answer that question themselves. And again, I encourage you to take a look at your Social Security situation and work with your financial advisor to come up with the best decision that works for your circumstances. Thank you so much for joining us today, and look for those slides to come in the next week or so.
Great. Thank you so much, Kara. We really appreciate your candor and your comments and all the insights that you share with us this afternoon here. Again, I want to thank everyone else that's on the line as well for investing the time and taking some time out of the day to spend some time just learning about Social Security and all of the benefits. We definitely hope that you found this information helpful and impactful, as well as a good use of your time this afternoon today. For those of you that would like to review, I know I got access to the Q&A here. We had lots of questions, about the presentation and when we're going to get that out. And if you'd like to share the presentation with a friend, a colleague, someone that's in the family, in about a week from today, we're going to make this presentation as well as the recording of today's call available to your financial advisor and your wealth management team. So definitely lean on your Baird financial advisor and your wealth management team to get any of the resources or get connected with Kara or anyone from our financial and estate planning team to delve a little bit deeper into any of your questions that may not have been addressed today. Again, we'd like to just go ahead and welcome you all to join us again next month on a similar note, but along the lines of advanced planning. We're going to be talking about charitable giving September 15th for our next Baird Wealth Strategies call. So we look forward to having you all join us then. Again, Kara, I just want to thank you for taking time out and giving us your insights and your expertise and enlightening me a little bit on Social Security as well as everyone else on the line. Everyone enjoy the rest of your day. And then just one last note, about a week from today is when you should expect to be able to grab hold of this presentation as well as the recording for today. Thank you all for joining us and hope you enjoy the rest of your day.